This is the Asia Trade. I'm Avril Hong in Singapore.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. A renewed spike in oil is stoking fears that the war in Iran will fuel inflation. Short-dated treasuries slide, with traders no longer fully pricing in one Fed rate cut for this year. As Trump shrugs off oil concerns, Iran's new supreme leader says the Strait of Hormuz should remain closed. Plus, the US, Japan and the EU are set to announce plans for a trade agreement in critical minerals, and that could include tariffs to counter any market distortions by China. Well, we head into the end of the week of trading, much like the way that we began, with these overarching concerns over the oil price, energy price hike, and that feed through to inflation concerns and policy concerns for central banks. Remember, next week we're heading into a major central bank decision week as well, and they're really, a lot of these central bankers stuck between a rock and a hard place in terms of the risks to inflation, to growth, and their policy stances. But take a look at how we're setting up as we get into the start of trading here in Australia. We had, of course, really a slide in Aussie stocks as a soar in oil really only drove gains across the energy sector. Those energy-related stocks really advancing as we saw that jump above $100 a barrel for Brent. Oman clearing all vessels from its key export terminal. 2 tankers attacked in Iraqi waters. And now Iran also saying that the Strait of Hormuz should remain closed. So we'll watch to see if any kind of relief rally gains could be repeated as we saw earlier in the week. But the aspect of confidence and sentiment overall is looking pretty dire at this point.
Yeah, to your point about Brent above $100 a barrel, that is the highest settlement since August 2022. We're seeing WTI hovering just below the 97 handle. And these higher energy prices are dragging up yields as well, especially on the short end. And traders are coming to terms with all this, given the energy part of the equation and the impact on inflation, and how they're no longer fully pricing in that one cut from the Fed this year. Of course, next week we have that Fed decision. And at this time, it's interesting, you're hearing the rhetoric from Trump ramped up on Powell, and tech came under pressure overnight. You saw those declines on the Mag 7s. It's not just because of rates, it's also because of some of these software concerns that are hitting tech stocks. We're seeing Adobe that's in the spotlight. Financial-related names are also in the spotlight, given these private credit concerns. Now, all this is coming on from the ripple effects of the Middle East conflict, and Iran's new supreme leader says the Strait of Hormuz should remain shut and that Tehran will open other fronts in the war if US and Israeli attacks continue. President Trump, though, has shrugged off oil concerns and says preventing Iran from owning nuclear weapons is more important.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. They really are a nation of terror and hate, and they're paying a big price right now.
Let's bring in Bloomberg senior editor Derek Wallbang. Derek, you've been tracking the story for us day by day. What's changed in the past 24 hours? It looks like both sides are digging in even further.
Avril, I would say that the thing that I would flag to you this morning as Asia wakes up is a hardening of positions for Iran and the United States. Both Trump and Iran's new supreme leader struck defiant tones on the 13th day of the war. There was little relief to energy markets despite fresh efforts to increase supplies of energy, sort of both in the U.S. and around the globe. Trump is again pitching this idea of short-term pain, long-term gain. The idea that he said in a social media post on Thursday, U.S. Times, preventing Iran from having nuclear weapons and threatening the Middle East is, quote, of far greater interest and importance to me than the cost of oil.
He's shrugging off this sort of oil concern, even as we get into some pretty key questions over the impact over inflation. Is the US coming up with any strategies or sort of offerings to try and alleviate this pressure?
Well, Heidi, we talked yesterday a little bit about some moves that Trump was taking to ease supply constraints. The biggest one of those, of course, is the release of oil from the Strategic Petroleum Reserve and other strategic reserves around the world. That really didn't do anything to dampen the price of oil at all. It's continued to sort of go up despite that. Trump has moved to try and increase some drilling in places he had wanted to do anyway, but that is a very small number, wouldn't really offset what you're talking about in the Gulf. And as I say, those are things that he wanted to do anyway and could take a very long time to come online at all. We are seeing one new move I should flag to you. There is a sort of long-standing U.S. provision. I won't go into great detail about what sort of ships can take things from American port to American port. Generally, there's an American-only vessel requirement there that's been a long-standing protection for the U.S. maritime industry. It's called the Jones Act. Trump is looking to waive that for 30 days for certain products, including energy, to try and to decrease the cost of carriage from one point to the other. So you are seeing some ways, let's call it creative ways, that the White House is looking to try and intervene a little bit here. But I'll tell you, I was coming in this morning. I looked at a gas station near me on my way into work. The price of gasoline there, $5.89 a gallon. And we've talked a little bit about how on gas stations across the United States, these are just billboards about the price of inflation, and people are seeing around the country these signals that things are getting more expensive as a result of what's going on in Iran. And all of this is playing out against a context where in the U.S. is a midterm election year and affordability is the top issue. So Trump is feeling some amount of political pressure here, and I think both sides, the question is who's going to blink first.
Yeah, on top of the energy costs, Derek, it's also the military costs, right? As this war drags on, the military costs for the U.S. How much is that perhaps being an issue politically for Trump?
It's one of those things where and I've had family members who have served, and you as somebody who's in the family of people who are overseas in any sort of situation, you're really, you're thinking about them most of all, and the sacrifices that U.S. service members make are top of mind when you get reports come in about casualties, and casualties in this do happen. They're a bit of an inevitability, as some American officials have said. The more that comes in, the more that people sort of sit there and take a very sober view of what's going on. Now, across this conflict, there have been far more casualties on the Iranian side of things, but make no mistake, that's going to be something that is going to be a point of pressure. We saw as well, just in the last couple of minutes, I think the last hour or so, CENTCOM come out with a statement that there had been an incident over friendly territory of a refueling tanker going down. We don't have the condition of the people who were in that plane, but make no mistake, these sort of the casualty of war is very, very, very real, and it is one of the most serious things that you can do is put service members in any country in harm's way, and that is going to have an impact for sure. And as I say, it's all part of this. You have to take a look at the pressure sides of this conflict, and when you're trying to sort of see where are these off ramps. We talk a lot in a market space about costs being one of those pressure points on off ramps, but as we've gone through in this conflict, one of the things that we've seen is that it has not been localized to just one or two, kind of military establishments. This is something that's hitting energy infrastructure. This is something that, you're getting civilian casualties here. And the scale of this and the cost of this, as broadly as you want to think about the word cost, continues to rise, continues to escalate as the days go on.
Bloomberg senior editor Derek Wallbank there for us. Let's take a look at the market implications. Yields soaring in the US as the angst over the war fueling inflation fears. President Trump wants the Fed to immediately cut rates, but markets are no longer fully pricing in one cut this year. Let's bring in Garfield Reynolds, who leads Bloomberg's MLive Asia coverage. So you do not envy being at the Fed at the moment in that decision-making seat.
Yeah, well, it would have been a tough Fed meeting even if the war had, without the war, because you were facing, remember, before the war began, partly because oil prices had already started to move higher, but also because of the impact of the AI boom on demand for metals, electricity, and so on. You already had a situation where there were signs of a reflationary impulse in the US and elsewhere. But then for the Federal Reserve, you had the rather alarming jobs report that just came out that showed job losses. So you would have had a tough meeting, probably thinking you were going to hold because you wanted to be sure that inflation was going to get under control, but leaning towards cutting sooner rather than later because of concerns about the jobs market. Now you've got this oil shock. The impact that's having on inflationary expectations is going to make it, you would think, impossible for them to even seriously consider a rate cut in that environment. At the same time, they can't really do too much to try and rein in inflation because they've got that concern about what's going on with jobs. So it's going to be tough, not from the point of view of that the easiest thing is probably that they won't do anything. They will leave rates where they are. The real difficulty is how on earth do you talk sensibly about what might happen in the future when the present is so extremely unclear.
Where do you see the pain points in today's trading?
I think equities are the pain points. You had declines in US equities overnight. You've got these private credit worries continuing to feed into the equation. And who wants to go long equities into this weekend? Yeah, maybe over the weekend there is something that looks like progress towards a resolution, a cool down in those positions, which, as Derek was highlighting, have hardened over the last 24 hours. And perhaps Monday morning things look a bit more optimistic. But you're going to be very brave to actually add to long positions going into the weekend, considering what's happened the last 2 Mondays.
You talk about long and short. I mean, I wonder which part of the curve are you perhaps more worried about at this stage?
I think by now I'll probably be more worried about the long end. You know, there's been some pretty severe repricing in the short end as traders accept that the Fed is not about to cut rates in the foreseeable future as long as this war is going on, and you've got a rush to pricing in the potential for not just one but several rate hikes for some of the other central banks. The traders are now pricing for the RBA to hike rates 3 more times by the end of this year. So that would take the RBA rate back to the highest since 2011 and be a very rapid reversal of last year's rather brief, as it turned out, easing cycle. So with that going on, a lot of the short end pain has been priced, and you might actually get an acknowledgement in next week's meetings that a rapid series of rate hikes would be very dangerous because economies are all facing the potential for demand destruction. So I think the short end might have priced in a lot of pain. The long end, though, if we are going to get further increases in inflation, that in the short term is poor for the long end. And then you have the potential for lots of volatility precisely because there's the demand destruction, there's the potential that economies break down. There's also what's been going on again with private credit. That's this cloud on the horizon that keeps on coming, keeps on sitting there, and you're wondering when it's going to start raining. So you have a lot of potential for a lot more volatility at the long end, which also, that is where you can get the biggest price moves. So I think I'm more worried about the long end, but basically be worried about bonds in general.
Hey, on private credit, if it becomes from a cloud to a downpour, I mean, how do you see it transpiring in terms of the specific systemic risk it might pose?
Well, the systemic risks are clearly there. If you have severe losses in that space, that's going to cause contagion. You have the potential for credit spreads, public bonds, public corporate bonds. Those spreads are still pretty tight on an historical basis. So a reversal there could really hit them with some whiplash, and then that can spread across into regular equities as well. The concern out there is that a lot of these private credit shares some of the basic characteristics that were behind CLOs and CDOs and CDSs back in the lead up to the 2008 crisis. Not the specifics of how they're set up, but the basic idea that here is something that you can get higher yields on than you would get from regular publicly traded debt, but the risk is supposed to be at about the same sort of level. Well, there are a bunch of German investors in 2007 that learned just how dangerous it was to be investing in mezzanine CDOs that were sold as being as safe as AAA with higher yields, and they turned out to be nowhere near as safe as they as they might have thought. So you've got the potential for a repeat of that sort of damage.
Some really interesting BI research on helium, but when it comes to what we're watching in Korea Open in particular. Yeah. But is this just an indication of, yes, it's energy markets, it's crude shipments, but there are a lot of flow-on effects to different industries and sectors that perhaps we haven't even started thinking about yet? Yeah,
very much so. There's actually been other research pointing out that physically the crude oil market is in decent shape. Maybe not so much here as far as Asian suppliers, but globally. And I almost feel like what's going on with crude prices is partly an attempt to price in the full gamut of energy and energy.
To express.
Yeah, because you don't have helium futures. You don't have futures on a whole range of products. And one of the things that the Gulf nations did over recent years or even decades was takes some of the money from their crude sales and invest it in downstream, in producing other things, including helium, including fertilizers, oil products in general. So those are the second and third order disruptions that have the potential to deliver a lot of pain to equities, to economies in Asia in particular. Asia has become very dependent on the Gulf for a whole range of things. So that Strait of Hormuz being shut is very bad news for a lot of global markets, especially for Asia.
Because there's no real substitute as well for these chip makers when it comes to helium also. So another risk we're watching for the session today and indeed next week. Garth, thank you so much. Great to chat. Garfield Reynolds, who leads our MLive Asia coverage. Coming up on the Asia trade, ANZ will be with us to talk FX as the yen hovers near its weakest level against the dollar this year. And later, BCA Research joins us to explain why they see a 70% probability of a prolonged war in Iran. Plus, we'll hear from the CIO of the Australian Retirement Trust amid a volatile market environment. All that and more ahead. This is Bloomberg.
Wednesday, the Fed decides.
Here we go again. Jay Powell only has 2 more of these meetings on the calendar.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
The potential risk scenario for the Federal Reserve is simply that they remain on hold for longer.
Certainly the Fed is no longer cutting.
Prices are going to go up. You might begin to see even more upside pressure on inflation from an already pretty bad starting point.
Is this too highbrow today?
Tune in to Bloomberg Surveillance. The Fed decides.
Adobe CEO is resigning from his position with no immediate successor. Shantanu Narayan has served in the role for nearly 2 decades, but the company has faced deep skepticism about its ability to thrive in the AI era. Let's bring our Asia Tech correspondent Avril Jewellers now on bell. This comes as Adobe reported earnings. What did we learn?
Yeah, well, actually, just to say a brief word on the earnings, the numbers were pretty solid, and that was sort of the consensus from many of the analysts that we polled on it. But really, it was that news of the CEO resigning or stepping down that, of course, has caused the most shockwaves, and indeed we've seen that stock slumping in late trade. But this is a company that is really at the forefront of some of the concerns around the software space. So like Atlassian, for instance, like Salesforce, it's really seen as struggling to win customers in the face of AI upstarts, even though Adobe has been working to try and integrate AI offerings or tools through its different product lineup. It just does have very pricey products, of course, and a very dominant market share that's being eroded or at risk of being eroded. Narayan, oversaw a huge period of growth at the company, but ultimately stepping down, and then that search for the right leader begins.
So, Belle, that's maybe one company that's not quite seeing the tailwinds from the AI boom. But let's shift to China, because chip designer Cambricon has reported numbers, and it is certainly benefiting from the AI boom.
Yeah, that's right. So in a different way, of course, but Cambricon is a chip designer in China. It's really trying to not only take market share from NVIDIA, because NVIDIA's lost the mainland market, at least for this stage, also locally from Huawei as well, but they just reported their first ever annual profit. So the number's actually just shy of, this is on a net income basis, just shy of analyst estimates, but coming in at around $306 million for the period. That was 2.1 billion yuan. You compare that to where you were in 2024, which was a 452 million yuan loss. So yes, full year basis as well, they've moved into 6.5 billion yuan in revenue, up from 1.2 billion yuan, but certainly, as I said, a company that's looking to continue to be at the forefront of China's efforts to build out its self-sufficiency.
Belle, thank you so much. Annabelle Drollers for us there. Some other top corporate stories we're tracking. Honda Motors faces up to $15.7 billion in charges and a historic annual loss following an unraveling of the EV transition. The car maker will cancel the development and launch of 3 EV models planned for North America. Honda's net loss could be as much as $4.3 billion, its first since it began disclosing consolidated results in 1977. BMW sees little room for improving profitability this year because of tariffs and intensifying competition in China. It expects an automaking margin of 4% to 6% after it declined to around 5% last year. The company said sales in China, still BMW's largest single market, will remain broadly stable. CEO Oliver Zipse has managed to keep the luxury car maker steady despite supply chain shortages and an uneven shift to EVs. Stellantis exploring deals with Chinese car makers to invest in its European operations, including acquiring stakes in Maserati or other brands. Bloomberg has learned company executives have met with China's Xiaomi and XPeng to discuss options. Sources say the talks also covered access to automaking capacity as Chinese firms seek to grow in Europe. More ahead on the Asia trade. This is Bloomberg.
Take a look at some of the early movers in the Aussie session this Friday. Qantas is down by just about 0.5%, agreeing to pay 105 million Aussie dollars to settle that flight credit class action stemming from the COVID period that was brought against the airline in August 2023 with no admission of liability. Also watching Northern Star shares falling the most in about 6 years after we saw that guidance underwhelming. Take a look at how we're setting up for the rest of trading. It's going to be quite a challenging day again when it comes to risk sentiment. We're seeing equity futures pointed to the downside, bonds also putting pressure as we head into a big week for central banks as well. All of this following Wall Street low, that renewed oil spike stoking concerns that this war that's ongoing will further crimp energy supplies, further fuel inflation and really trouble these central banks as they decide the best path forward when it comes to policy. It really follows concerns over another surge in the oil price, Brent closing above $100 for the first time since 2012. When it comes to that quarterly jump, that's something that we're watching as well when it comes to prices. In the meantime, the US, Japan and the European Union are said to be preparing a critical minerals trade deal with a price floor and new tariffs to counter China. Our Bloomberg editor Laura Curtis joins us now from Los Angeles. And Laura, what are we hearing in terms of what's being planned here?
Yeah, so my colleague Jenny Leonard broke a story earlier today that the US, Japan and the EU are getting closer to an agreement on these critical mineral tariffs and price floors in an effort to counter the distortions that they say are coming out of China. Now, this comes after, you'll remember last year when China put export controls over these really essential materials and pretty much cut off the rest of the world from these critical minerals. And so this is the sort of coordinated response to that action by China.
We're also watching Europe, particularly Paris this weekend, because Jameson Greer and He Lifeng are set to meet. Given the Iran war, the trade war overhang, how are they likely to pave the way for the Trump-Xi meeting, the planned summit later this month?
Well, we expect them to at least be talking about soybeans. We know that you'll remember I think back in October, Trump and Xi agreed to extend the pause on the worst of the tariffs that Trump had planned in order for China to resume purchasing U.S. soybeans. It's a really politically tricky situation for Trump, where China has basically had stopped buying U.S. soybeans from U.S. farmers, and they ended up fulfilling their commitment, at least in part, with a big purchase back in October, but have since stopped. So it's probably gonna I'm not sure how much we'll find out from this meeting, but it's clear that that's going to be a topic of conversation for sure.
At the same time, there's still uncertainty and developments when it comes to the trade front, right? We know that this week a new set of trade investigations are going to be underway to try and rebuild Trump's tariff wall, but we're also hearing that some progress is being made in this process of potentially delivering refunds.
That's right. This is a huge relief, could be a huge relief for U.S. importers who've spent the last year paying these IEEPA tariffs that were recently found to be illegal by the Supreme Court. CBP had file an affidavit with the trade court today, that was an update on their plans to put a new system in place, which they're calling CAPE. It's an acronym, so that's kind of nice. They initially said that it would be ready within 45 days. There was no update to that timeline in the affidavit listed today. However, it does seem like it's going to be a nice way for importers to streamline their claims to refunds, although it's still unclear how the process will treat more complicated entries like those importers who've been paying more than one type of tariff at a time. Remember, the Section 232s and 301s and all these other tariff authorities are still very much in place on things like metals and a lot of goods from China. So anytime that it gets more complicated than just removing that IEEPA tariff from the entry, I think this could take a lot more time.
Laura, great to have you run us through these latest details on tariff refunds potentially. Bloomberg editor Laura Curtis in Los Angeles for us. Top global headlines we're following as well. Russia said to be currently providing Iran with various forms of intelligence, including satellite imagery and drone targeting tactics, in an effort to help Iran hit back at U.S. forces. But Bloomberg sources added that it's uncertain to what degree the intelligence shared is effective and timely. Moscow and Tehran have deepened military cooperation after Russia's invasion of Ukraine in 2022. An armed man was killed after ramming his vehicle into the front doors of a synagogue in Detroit. The FBI is calling the incident a targeted act of violence against the Jewish community. Authorities say the vehicle breached the entrance before security personnel engaged the suspect with gunfire. None of the synagogue staff, teachers, or children at its early childhood center were injured, but one member of the security team was taken to hospital. Bloomberg has learned that India urged China to allow the sale of some urea cargoes. Sources say Indian officials have asked their Chinese counterparts to consider easing export restrictions as an expanding conflict in the Persian Gulf upends supplies of LNG and forces some fertilizer makers to shut plants. China controls urea exports under a quota system and has yet to allocate allowances for outbound shipments this year. And you can also explore live streaming news and interviews, as well as all Bloomberg TV shows, documentaries, reporter analysis, and more in one place. Check it out at bloomberg.com/videos. This is Bloomberg. Now, perhaps as part of efforts to ease the upward pressure on energy prices, we're getting breaking news crossing the terminal. The Treasury is telling us that the U.S. has issued licenses or is issuing licenses to authorize the sale of some Russian oil. And of course, this is already following on from some of the developments since the war began in the past week, where Indian refineries were allowed to take on some Russian oil. But we have been seeing this upward pressure still, the climb in WTI. Don't forget, Brent is above the $100 a barrel handle. We'll see how it starts in Asia in the next hour. For the moment, tracking some of the FX moves as well, with the Japanese currency against the greenback sitting above the 159.3 handle. That relative weakness is standing out. Aussie at 70 cents thereabouts. Of course, we have central bank meetings next week. Against this backdrop, the dollar has continued its climb. Now, our next guest says the US dollar is going to stay strong for the short term, but see weakness over a longer period. Joining us now is Mahjabeen Zaman, Head of FX Research at ANZ. Mahjabeen, good to have you on the program. So talk to us first about what you've been seeing in the past week and a half or 2 weeks in the dollar resurging after those bearish bets on the greenback for much of last year. What's changed on top of the Iran war?
Look, I think a couple of things. I mean, there has been some indications on the macro front in the US as well that there are some elements of price pressures picking up. When we look at activity indicators or we look at the PCE, the last one came out a little bit higher than the Fed's comfort zone. That combined with, of course, the war, which kind of is now where US now is attracting your haven flow. Oil prices are positively correlated with the dollar. Clearly is pointing to that near-term upside or a strength to the dollar. Now, I think, the dollar strength is likely to retain for the time being, until markets receive some headlines relating to maybe a ceasefire or reopening of the Strait of Hormuz or restart of production. Until then, we think dollar will be likely supported.
Yeah, I guess to your point, the thing is we don't know how long this is going to drag on for. It could be weeks, some pricing in maybe months. If we see some form of solution to the conflict in the Middle East, how long do you think the strength in the dollar will take to dissipate?
Look, I think, bottom line is that Russia and Ukraine, the onset of that is fresh in our minds. And, we saw oil prices sustain above 100 for around 3 to 4 months during that period. Natural gas prices peaked after about 5 to 6 months. And so I think, in terms of that, and that obviously followed the dollar strength story as well. Of course, this time things are a little bit different. We think that the dollar strength, if there is some sort of a positive outcome that we hear, I think dollar will likely kind of start easing back somewhat. And the reason for that is that the Fed story still remains valid. The disinflationary pressure that we just saw in the CPI yesterday, and overall the momentum in the US, we think that Fed cuts are very much on the card, and it's just a function of when they will be, depending on the offsetting impact of the war.
How likely is it that we'll see the extension of the Aussie rally, particularly with the very rapid repricing we've seen around the RBA?
Look, I think for the Australian economy, a couple of things, right? The starting point today is one of already a higher inflation. You know, we are standing at, like, headline inflation came out about 3.8% in January, well above the RBA's target band. So even before the war, you know, we were not in that comfort zone, and, you know, we were thinking about those hikes coming in. So this now, coupled with this, you know, near-term inflationary concerns, is surely now seeing that, you know, leading to that repricing. In fact, we continue to think that next week the RBA is going to raise rates, and then another one in May as well.
So, in view of that, do you think there's further to go for the Aussie rally?
Yes, definitely. We think that the Australian dollar will likely rally further. We're looking at a year-end forecast at about 73. And I think that's also, again, you know, the positive terms of trade shock coming from elevated energy prices is an added impulse for the Aussie. And it's we're doing this is coming at a time where there's, you know, nobody else has started hiking yet.
Well, one currency the Aussie has certainly rallied against is the yen. What are the levels you might be watching? And what's at stake for the BOJ going forward? I mean, we're also watching out for intervention levels potentially out of Japan financial authorities. And it does seem like the bar there has gotten a bit higher.
I 100% agree. You know, for some time we have been calling that, you know, the typical 160 mark where we saw intervention previously probably is not the same as now. Look, I think currently dollar yen is moving higher, not because of speculative moves, but more because of macro fundamentals. You know, there's a risk of higher imported inflation coming through and all of that. And that's really what's driving it up. So for them to come in and intervene at this stage is a little bit harder to justify, you know, given that this is in terms of trade story rather than speculation. However, again, you know, going back, we think that the bar is higher, probably above 162 before we see any intervention coming in. At the same time, when we have BOJ meeting next week, it'll be an interesting outcome from there in terms of which way they're leaning, because, you know, just this week we saw real wages turning positive for the first time in many months. And that kind of reinforces that normalization story for the Bank of Japan.
How much event risk around the BOJ next week for the yen, though? Because we have been seeing them at moments in the past year or so fumbling the messaging. So I wonder, you know, how much they would have to telegraph that they are going to hike at some point for there to not be further pressure on the Japanese currency.
Yeah, look, I think probably they have to be a whole lot hawkish, if anything. Look, you know, previous meetings, as you rightly said, have been disappointing in terms of commentary, and it's only seen a weaker yen at the end of it. But going forward, I think, you know, if anything, that it also depends on where oil prices are next week and what that level is, and whether the market kind of buys in the governor's hawkishness, if at all. I would still argue that probably the biggest thing that's driving yen right now is really that terms of trade shock more than anything else. You know, traditionally yen used to be a safe haven currency. Not seeing any of that play out in this cycle, at least.
JP Morgan, for one, saying buy the yuan because it's a haven. Do you sort of understand that rhetoric? Because at times like this, Chinese assets are often seen decorrelated.
Yeah, I think CNY has been strengthening gradually for a period of time, and I think that will continue going forward. And I think, yes, they are somewhat insulated to a certain degree, just given that they have been holding a larger stockpiles of oil before this pandemic, before this event as well.
Mahjabeen, great to have you with us. Mahjabeen Zaman, Head of FX Research at ANZ. And let's get back to our top story, which continues, of course, to be oil. Some pretty interesting developments we've seen over the last few minutes. We've seen the US Treasury giving a license authorizing the sale of crude oil from Russia, so authorizing some Russian oil in terms of this issuance of a Russia-related general license. We've further seen a little bit more detail from Secretary Scott Bessent, the Treasury Secretary, saying that the President is taking decisive steps to promote stability in global energy energy markets, working to keep prices low as we address the threat and instability posed by Iran. So that authorization, according to Scott Bessent, only applies to oil already in transit. It won't have significant financial benefit to Russia. This authorization is a short-term and narrowly tailored measure. So we'll continue to watch that in terms of the impact that we could see. At the moment, still quite a bit of elevation for crude prices. We've got oil trading close to a 3.5-year high as Iran continues to vow to keep the Strait of Hormuz closed, rising from its highest close since August 2022. It's been a dramatic week of pretty extreme fluctuations, if you will, but that trend has just been to see it go higher. And of course, we've been looking at it sort of if you zoom out and take a look at the implications on a longer-term basis for the quarter. Brent crude is set for the third largest jump since the 1980s. Well, coming up, we explore Asia's rapidly growing ETF space. Our new weekly segment, ETF IQ Asia. Catch our exclusive with the CEO of CSOP, Hong Kong's largest ETF issuer by assets under management. ETF IQ Asia airs Fridays on The China Show. This is Bloomberg.
Mattel is expecting a strong year for its brands such as Hot Wheels, even after recently reporting holiday results that fell short of estimates. Speaking with Bloomberg, CEO Ynon Krais says they are also monitoring the impact of the Iran war on supply chains.
Too early to tell, but as I said, this is an industry that is driven by innovation and big brands. The importance of big brands is higher than ever. In a world of unlimited shelf space and ubiquitous distribution, this is not just in toys, it's also in entertainment and other consumer-facing parts of the industry, of the economy. So big brands are always going to stand out, and this is exactly the core part of our strategy. How do we leverage the strength of our brands, the fact that people are proactively looking for opportunities to engage with our brands, to create experiences and product that stand out and continue to excite and delight fans all over the world.
How do you do that with Hot Wheels specifically, Ynon? Because Barbie, you know, I see everywhere, and we all watched the movie, and there's no question about where to pick up those products. With Hot Wheels and Matchbox, I'm not really sure where to go to get these things. Sometimes I see them like on an otherwise empty shelf at Best Buy, or occasionally they're in the supermarket at the checkout. But I don't really see the kind of visibility for those cars that I do for the dolls.
Well, Hot Wheels achieved last year its 8th consecutive record high. And we expect another strong double-digit growth year for Hot Wheels in 2026. Hot Wheels is perhaps one of the best representation of our brand strategy and how we continue to grow our IP-driven play and family entertainment business. You're seeing innovation in Hot Wheels. We're expanding play patterns, user demographics. We're seeing a very large contingent of adult fan and collectors. We're offering more content, more experiences, stunt shows, the Hot Wheels Legend Tour, mobile games, and it's becoming a lifestyle brand. It's much more than a toy, it's a lifestyle brand. And we sell product in 500,000 stores globally. Hot Wheels is in every single one of them. And the good news, bad news in what you just described is that in some cases, we cannot keep up with demand. There is a lot of excitement around Hot Wheels. And you should also look at Mattel Brick Shop, which is our Hot Wheels branded building set play pattern is something we launched last year and selling like hotcakes. We cannot keep up with demand. It's really about innovation and bringing these brands to life in new ways that delight fans and continue to evolve and expand the experience beyond the toy aisle.
That's Mattel CEO Ynon Krais speaking with Bloomberg's Mark Miller. The latest when it comes to some of these corporate headlines that we're following, and PayPay shares jumped in its trading debut after the digital payments firm's $880 million US IPO. The company's ADRs closed at $18.16, above its IPO price of $16. This gives the company a market value of around $12.1 billion. PayPay's IPO is the largest by a Japanese company debuting in the US since mobile messaging service Line's listing in 2016. Blue Owl Capital has defended its recent sale of $1.4 billion of loans, arguing the transaction contained no backstops or hidden incentives. Co-president Craig Packer says the four institutions that bought the debt conducted their own due diligence and received no special guarantees. The sale was part of a plan to return cash to investors in the firm's Blue Owl Capital Corp 2.
Now, Haidi, of course, overnight we did see some of those private credit concerns weighing on financial-related stocks, but tech also stood out in the US. They were dragged, those Mag 7s. Actually, if you look at a gauge of them, they are on the brink of correction. And it's not just about the elevated rates levels that are hitting them. Software concerns are also affecting tech-related names, including Adobe, after its lackluster forecast, but also that news of its CEO stepping down. And against this backdrop, it's going to be a bit of a struggle, I think, for South Korea. Look at the way futures are pointing. Yes, you have maybe a bit of insulation from the market turbulence with this promise of an extra budget, but think as well of these concerns among investors for chip makers at a time where helium shortages is entering the discussion. So that is what's at play for the Asia Open as well. Haidi?
Yeah, we're watching Japanese assets in particular, given we've seen some concerns over where the yen is trading at and perhaps how there might be a higher resistance to intervention, even verbal intervention at this point. But Japanese government bonds are also in focus, given what we've seen across the Treasury and sovereign bond space generally as a result of these renewed, more intensified inflation concerns from the energy price hike. But JGBs are vulnerable to further declines, and foreign investors have been flipping to being net sellers. We've seen data showing that overseas accounts offloaded just over 1,800 contracts in the week that ended on March 6. That's the first net selling that we've seen since late January. And of course, offshore investors make up more than 70% of JGB futures trading. So we're watching this shift very carefully as cash yields climb. We've seen the largest net sales from foreigners of medium to long-term bonds since September of last year. The market opens are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and the energy story, the inflation risk story continues to build, Avril, as we head into a week of critical central bank decisions. A lot of these policymakers are really trapped in a difficult space.
Absolutely. And this is coming against the backdrop of some of these measures from the US to perhaps allay the climb in energy prices. We're hearing how the US could be allowing more Russian crude into the markets in some shape or form.
Yeah, that's going to be an interesting policy to be interpreted. Scott Bessent saying that this is a very narrow issuing of a license for suppliers that are already on their way. But let's head straight into the start of trading in Japan and South Korea, because when it comes to these markets, in particular for South Korea, these foundries and chip makers, it's not just about the energy crisis and the oil crisis. It is about shipments of helium as well, looking at these helium shortages, which of course are critical when it comes to some of their foundries and the chip makers. But interestingly, we've seen some research from Bloomberg Intelligence suggesting that we'll see that tail risk really start to come through in about 3 months' time. At the moment, though, that open across the Nikkei 225, Japanese stocks are off by just about 1.5%. The yen is trading now at that 159 level, as we see perhaps a little bit more appetite for how that trades, given the threshold that we usually see for the zone for verbal intervention. We're also watching JGBs very closely, given that we've seen seeing quite a bit more foreign selling in that market as well. Flipping it out to Korea, and as I mentioned, it's really about this helium shortage, and we could continue to see that pressure when it comes to chip makers today, watching the likes of Samsung, Hynix, both down by just about 4% in the early part of this trading. The Kospi down by about 3.25% so far, Avril.
Yeah, you talk about some of this jaw boning, right? And in terms of what we've gotten from the US so far, letting Russian oil into the markets, you can see based on the way in which Brent has opened, even higher than the settlement overnight. 101 is where we are on Brent crude. That's done very little to allay concerns as long as the Strait of Hormuz remains effectively shut and these strikes continue. The damage to Gulf production infrastructure is weighing on markets, and that concern is rippling through in terms of what this means for the markets, energy-specific, inflation read-through. You're looking at the 2-year yield pulling a bit lower in the US, but we did, of course, see the short end. Really, the pressure was showing out in the overnight session. The dollar is coming under a bit of pressure. Tech was dragged overnight as well. Let's bring Garry Evans, Head of Research Solutions at BCA Research. Garry, really good to see you. Talk to us first about what you're seeing in terms of the risk for the markets after what's been a really crazy 2 weeks.
A crazy 2 weeks, but the S&P 500 in the US is only down, if I calculate it right, 4% from the peak. So I think there's a lot of risk that's not priced in. Oil price is up 60% since the beginning of the year. The rule of thumb is historically when you've had a 100% rise, a doubling of oil prices, that is, without exception, led to a recession. So I think the probability now of a recession globally has risen significantly unless we see an end to the Iran crisis within the next few weeks.
So for US stocks in particular, you see more to come in this repricing. Is that going to be led by tech lower, or are there other sectors that you think we should pay more attention to?
So I think that's a whole separate issue, that the AI bubble, in our view, has been in the process of bursting for a couple of months, and those valuations are still really expensive, so they probably continue to come off. But the recession would be worldwide. And of course, the US is a relatively low beta market. It has quite a high proportion of defensive stocks. And the US, of course, is a net oil exporter. So frankly, the East Asian markets and Europe are going to be much more heavily hit, I think, partly because of the dependence of those economies on imported oil and gas and other petrochemical products. So probably for the short term, at least, the US market would actually end up being a relative safe haven.
Talk to us as well about what you're seeing in the Asia Pacific. If the US is seen as a sort of safe haven, how much under pressure are you expecting on Asian assets?
So a lot of it really comes down to the dependence on oil. If you look, for example, so the US is a net oil exporter. China imports about 40% of its oil from the Middle East. Japan imports more than 90% from the Middle East. China is obviously a very manufacturing-dependent economy. It's much more energy-intensive than, for example, the US is. And then you've got a market like Korea, which ran up dramatically in the first couple of months of this year. And not only is Korea very dependent on imported oil, but it's also quite an expensive market relative to its history as well. So I think in this sort of world, at least for the next few weeks, the US looks like a relative safe haven, and the Asian markets probably are much more at risk. So where would you look for hedges, if you like? You probably want to look for economies and markets that have quite a lot of energy companies in their indexes. So that would be Australia, for example, Canada, amongst the emerging markets, Brazil and Mexico. Those should end up relatively safe compared to countries that depend on oil imports.
Do you buy into the thesis that China remains a good hedge in terms of decorrelation from global geopolitics, the fact that the economy is more advanced in electrification than others?
So I was in Shanghai and Beijing the first 3 days of this week, and it's certainly true, talking to Chinese investors, they are very sanguine about the risk. They say, oh, no, China is fine. So that worries me. And I think in the short term, therefore, China is actually probably more vulnerable than most people believe. The positive story, though, for China, and at BCA we're overweight on the Chinese offshore stocks, is that because the economy is already pretty weak, the property market is still in a terrible state. The MPC last week didn't really produce any new measures. I think by mid-year, the Chinese authorities will understand that they'll have to roll out more stimulus measures. So it might be like a mini 2008, when China did its usual playbook of infrastructure spending. Our expectation would be that perhaps by mid this year, you're going to see that, which could mean actually that the Chinese markets do end up being a little safer than some other markets around the world.
That's really interesting, Garry, because I think most people have fallen into the position that Beijing is now pretty comfortable with that slower pace of growth, that it is a new normal, that they're really prioritising tech, frontier tech, as the next area of growth. Are you saying that they're going to get increasingly uncomfortable to go back to that old playbook of investment?
So if you look at the Chinese economy, last year it was very dependent on exports. Despite the fact that exports to the US fell by 30%, a lot of it was just diverted via ASEAN, etc. That last year caused a boom in manufacturing investment. You know, as you said, it's the government focusing on this, but that is now coming off. The credit impulse in China is also slowing. There's not a lot of local government special bond issuance in the first half. So all our indicators say that the economy is continuing to slow, and therefore this new 4.5% to 5% GDP target that they announced last week, that's going to be pretty hard to achieve. And when they see that by mid-year, if, as we'd expect, the economy slows in the first half, the government will have to do something. And also remember that, of course, ultimately a lot of Chinese exports go to the US, with higher gasoline prices in the US, with a fall in stocks, which will cause a negative wealth effect. US consumers are going to be under real pressure as well. They're not going to be buying the sort of consumer goods that China's been selling them. So China will be under a lot of pressure, I think, to react to that with stimulus some point this year.
Garry, thank you so much for your insights today. Garry Evans is Head of Research Solutions at BCA Research. And Garry, just talking there about the exports dependence. Think about the likes of Honda as well. That Japanese automaker warning a $15.7 billion charge because of this global EV transition that hasn't panned out the way some automakers might like. After giving that annual loss guidance, you are seeing the drop in the shares of about 5%. And mind you, this is coming despite the weakness that we're seeing in the Japanese currency, Haidi.
Let's take a look at some of the tech names that we're watching. We mentioned helium as being sort of one major issue, not just the sort of top level oil price effect and the shipments that are not getting through the Strait of Hormuz, but as Gutford Reynolds spoke about earlier, this is perhaps a case where we're seeing some of these other concerns, perhaps non-tradable concerns over helium shortages hitting ship makers, for example, being also expressed through the surge in the share price. So in the oil price, I should say, we are seeing downside pretty firmly when it comes to the heavyweights, Hynix, Samsung Electronics, as well as some of the names trading in Tokyo, all down by as much as over 4% at this point, 4.5% as some of the worst players there. But really the concerns about global helium production being taken offline, about a third has gone off with the shutdown of LNG production in Qatar as well. So another hit for chip makers that rely on helium for manufacturing. It is really a physical supply constraint for a market that has already, even pre the war disruptions, been tight. More ahead on the Asia trade. This is Bloomberg. We do have some breaking news when it comes to responses that we've seen for various countries to these soaring energy prices and concerns over lower stock. We're hearing from Chris Bowen at the moment speaking about Australia's ability to lower fuel stock obligations. We'll be watching for more details. He's saying fuel supply is continuing to come into Australia, but that they will be lowering fuel stock obligations. This, as he speaks, the Energy Minister, I should say, speaking at a press conference at the moment. We'll continue to watch for that, but at the same time, we're seeing lots of really different actions being taken by countries around the world. For the US's part, we've heard that announcement in the last half an hour or so of a temporary lifting of sanctions on some Russian oil in an effort to contain these price surges caused by the effective closure of the Strait of Hormuz. We also heard from Iran overnight saying that they think that strait should remain closed. The US Treasury provides temporary authorization to permit countries to purchase Russian oil that's currently stranded at sea. All of this coming as we see oil trading close to a 3.5-year high, as it seems like there is at this point no off-ramp for this war. Well, Iran's new supreme leader says that the Strait of Hormuz should remain shut, that Tehran would open other fronts in the war if US and Israeli attacks continue. President Trump, though, has shrugged off these oil concerns, says preventing Iran from owning nuclear weapons is more important.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. They really are a nation of terror and hate, and they're paying a big price right now.
And let's bring in Bloomberg editor Michael Heath. So at the same time as we've heard that Russia has been providing Iran with levels of intelligence and drone tactics, we're also now seeing Russia potentially continue to benefit with some of this partial or narrow lifting of sanctions.
Yeah, that's right, Heidi. I mean, they're sort of they're playing both sides in a way. I think we spoke about this earlier this week, that they just are a beneficiary in the sense that they have these historic ties with Iran. President Trump has very warm feelings towards President Vladimir Putin as well, and we see sort of this extraordinary situation where President Trump apparently put to Putin that was Russia helping Iran, and was told no, they're not, and then you had US envoy Steve Witkoff parroting back what Putin is saying, which Vladimir Putin very, very rarely says what he means. So it was just a surprising naivety to see there. But yes, certainly Russia, its income for its war in Ukraine, and at the same time its payback to Iran, which has been supplying Russia with drones and drone technology to fight Ukraine as well. And Russia obviously still has this Soviet legacy. It's got the satellites and that sort of thing that can help Iran in ways that Iran just can't do.
There were some concerns about the health of the newly elected, or newly chosen, I should say, Supreme Leader, but he's come out and made a statement. It's defiance on both sides. It is. I mean,
both sides are sort of ratcheting up the rhetoric in a way. And what was supposedly happened is the new Supreme Leader was wounded in the attack, which killed his father, is my understanding. So he hasn't been seen publicly. What actually came out was a statement from him. But as you say, he said that the Straits of Hormuz should remain closed, and that they're considering new fronts against US and Israel, or the US if it continues the war. Now, what we've seen with Iran in the past is that there's been terrorist attacks, particularly against Jews in the past, because of their fight with Israel. So they've got all sorts of potential asymmetric warfare, and again, Russia is quite specialised in asymmetric warfare too. So I wouldn't be surprised if there's a bit of discussion going on there. So we'll just have to sort of see whether that's bombast or whether there's something behind that. But yeah, he certainly seems like he's fitting the mould of the hardline leader.
Mike, what we've seen in the past week also, especially given these reports of Russian intelligence going to Tehran, is how US adversaries are banding even closer together. I wonder, on the other side of things, how coordinated are the US and its allies?
Yeah, Avril. I mean, Prime Minister Netanyahu of Israel came out and spoke and said, obviously, that the relationship with the US is very close, because there had been some discussion about the different objectives of the two sides, and President Trump has said the same, that he and Netanyahu have the greatest relationship that any US and Israeli leader have ever had. But beyond that, you're right. The support for the US and Israel at the moment is tepid. Everyone obviously would like to see an end to Iran's nuclear program, and a regime that has exported terrorism and created a lot of instability. That would be fine, but it's just the sort of lack of any sense of direction in what's going to be achieved out of all of this that I think is really worrying the world. You may well see in cases like if they have to start doing escorting oil tankers and things like that, where the international community comes together. But it does look like Iran with Russia, and there's some reports of China as well, though China's denied that. has a bit more, a bit more structure or a bit more support in its alliance than the US and Israel at the moment. And sort of for all the technological superiority of the US, places like Russia have learned a lot from fighting modern wars in Ukraine in recent years that can be shared with Iran too. And Iran, obviously, through its proxies, has a lot of experience in warfare recently too. And we're seeing some of that as well in just this targeting of cities like Dubai and the oil infrastructure in the region and the pain caused by the oil price.
Mike, always great to have you on the show. Thank you so much, Bloomberg editor Michael Heath. Now, as the war drags on, current and former defense officials in Asia are growing concerned the U.S. may shift more firepower to the Middle East, leaving Taiwan and other places vulnerable. Let's cross to our Japan politics and security reporter, Alistair Gale. Alistair, it's this idea perhaps that the U.S. military assets, resources can't be in two places at once. Talk to us about what's the state of play, how worried some of the U.S.'s Asian allies are at this stage.
Right. So, yeah, we've been talking to a range of current and former officials. And, of course, this war is about 2 weeks in now. We don't know how long it's going to go on, but we're already seeing some assets being moved from the Indo-Pacific region, specifically U.S. destroyers, supply ships, refueling aircraft, and perhaps most importantly, missiles. And missiles are in great demand in the war in Iran, particularly air defense missiles to try and shoot down what Iran is firing back at countries in the region. But these are weapons that are needed in the Indo-Pacific region were there to be a conflict here. So what we're seeing is a beginning of a kind of drawdown in this region that raises concerns about readiness. Militaries and governments in the East Asia region, they're not expecting, they were not seeing any signs of any moves by China towards Taiwan. But, of course, this is one of the priorities these days. The US has talked about ensuring that the first island chain, as it's called, which includes Taiwan, Japan, the Philippines, is well defended. So what's happening now with military equipment being moved to the Middle East is starting to raise some concerns.
Alistair, we know that China's defence sector has come under increasing different pressures in recent years, but we also know that over the past few decades, these, periods of distraction for US security forces has enabled quite a significant build-up, particularly in this part of the world. Do we know how much of an advantage Beijing has, and do we know that if they might use that opportunity to build up further?
Right, so they obviously have a very impressive defense industrial base. There's certain areas where they've essentially overtaken the US, and shipbuilding is one of those key areas. We've seen lots of new Chinese naval vessels hitting the water in the last few years. They seem to be churning out submarines and even aircraft carriers at a rate that the US can't match. So that's one of the areas, I think, where there's some concern that if more equipment, if more naval forces get moved to the Middle East, you could have a hole essentially in deterrence. There is one American aircraft carrier that's based in Japan that was moved to the Middle East in 2010 for the Afghanistan surge. I think that's currently in maintenance here in Japan. But if that was to be moved, that would be significant because it's perhaps the biggest symbol of the deterrence effort against China. And so as you see the Chinese, able to deploy a much broader range of military equipment at great pace, the US is struggling to keep pace with that, and moving things out of this region obviously increases the scale of that challenge.
Our Japan politics and security reporter Alistair Gale there in Tokyo. And we are continuing to watch the press conference being held by Australian Energy Minister Chris Bowen there. Australia is saying that the fuel measures that have been suggested could be 5 million barrels under the IEA release. So there's been some concern in terms of the energy security aspect for Australia's fuel needs, whether there is any sort of fuel supply issue in Australia. We've heard Chris Bowen really being challenged on the claim that there is no supply issue in Australia, particularly when it comes to that rural supply. But we're saying at the moment here Australia to lower their fuel stock obligations, according to Energy Minister Chris Bowen there. More ahead on the Asia trade. This is Bloomberg. The US, Japan and the European Union are said to be preparing a critical minerals trade deal with a price floor and new tariffs to counter China. Our Bloomberg Politics editor Laura Davison joins us now from Hong Kong. And Laura, what do we know about the structure of this deal and potentially what the response will be? Because we know that Beijing has said that they would potentially retaliate.
Yes, so this deal would essentially look to set price floors for a whole range of critical minerals and rare earth elements. This would involve the U.S., China, as well as the European Union. U.S., Japan, as well as the European Union. And the idea here is to sort of act as a counterweight to China, which really has a lock on the market here. So these price floors would do two things. One, if it would sort of act as a counterweight to China dumping some of these products onto the global market, as well as provide some guaranteed rate of return for new investment and new companies to start mining some of these elements. The thing about rare earths is it's not so much that they're rare, they don't exist around the world. It's that they're very expensive, dirty, and labor intensive to mine. So they're trying to essentially create a scenario where the economics make sense for more companies to start extracting some of these minerals that are in everything from cars to computers to airplanes that are really critical to national security. You've seen the U.S., Japan, as well as the EU look to diversify their supply chains away from China, and this is one way they can do that.
Yeah, China has really been using rare earths as leverage. Talk to us also about some of the developments between the US and China that we're watching out for, especially this weekend when their trade representatives and high-level officials are expected to meet in Paris.
Yes, so this is going to be essentially the big meeting before Trump and Xi are scheduled to meet at the end of the month. So this will be Scott Bessent, Jameson Greer, as well as the top trade official in China, He. They'll all convene and really talk about all the different elements that go into this meeting. There's been some frustration on the Chinese side that there hasn't been more engagement, more planning from the White House side that would allow for a really comprehensive summit. The U.S. has been more focused on trade and economic deals. Some things that are looking to potentially be announced, including a Chinese purchase of Boeing aircraft, as well as sort of a renewal of where the trade agreement has gone. Of course, this meeting comes after the Supreme Court struck down a lot of those tariffs, and the U.S. is looking at different ways to sort of rebuild that Humpty Dumpty tariff wall. These are all going to be the issues that are going to be on the table, really with just 2 weeks to go before this leader meeting.
Laura, thank you so much. Bloomberg Politics editor Laura Davison from Hong Kong for us. Let's take a look at how currencies are tracking on a day where investor concerns still lie very heavily on the energy shock and their potential impact on inflation. Of course, don't forget that we are watching out for data in the U.S. on Friday, the Fed's preferred gauge of inflation. For the moment, the dollar is sitting a bit softer compared to where it was trending in the session. The Japanese currency is recouping some of those losses. It was sitting a bit further above the 159 handle against the greenback. Investors watching out for further signs, perhaps, of how much pressure and sensitivity there is for emerging markets' currencies to these oil price gains as well. More ahead on the Asia trade. This is Bloomberg.
Debt strategies relying on complex, opaque, and increasingly leveraged financing structure, notably in private credit, can also conceal the vulnerabilities of some borrowers, as shown by the collapse of First Brands or Tricolor last September, or more recently, MFS Market Financial Solutions.
The governor of the Bank of France sounding an alarm over private credit liquidity risks and the latest updates from that front. Deutsche Bank flagged a 26 billion euro exposure to private credit, an asset class grappling with fund redemptions. The German lender said its exposure to private credit represents about 5% of its loan book, while the bank identified the asset class as a key risk. It did not mention any losses tied to the exposure. Shares fell on Thursday after the bank also flagged a $1 billion litigation risk. Shares of Morgan Stanley fell in lockstep with stocks of top asset managers after the lender limited withdrawals from one of its private credit funds. Morgan Stanley is the latest money manager to cap redemptions after investors tried to withdraw far more than allowed. Private credit funds have grappled with a wave of redemption requests lately as concerns swirl around the quality of their loans. Blue Owl Capital has defended its recent sale of $1.4 billion of loans, arguing the transaction contained no backstops or hidden incentives. Co-President Craig Packer says the four institutions that bought the debt conducted their own due diligence and received no special guarantees. The sale was part of a plan to return cash to investors in the firm's Blue Owl Capital Corp. 2. Now, of course, we saw those private credit fears dragging the U.S. financial-related stocks overnight. Japanese lenders are also under pressure, tracking the declines in their U.S. peers, and that is actually the sector that is underperforming when it comes to the specific sectors on the topics for today. Haidi?
Underperformance is really the name of the game as we head into what has been just a frenetic week for trading, right, dominated by this oil story. We continue to see that as being front and centre. Now we're really focusing when it comes to the supply chain risks, adding pressure to some of the more tech-heavy names that we're seeing trading across the region. Interestingly, Nasdaq futures are a little bit higher at this point. We're seeing Euro Stoxx 50 futures also trading in the green. We did see European stocks extending that drop after we had the statement from the new Supreme Leader in Iran saying that he thinks that Hormuz should stay shut. Downside of about 0.5% at the moment trading here in Asia. Well, the Australian Superannuation Investment Summit is drawing to a close in the US this week. The event connects Australian super funds with global business and tech leaders, as Australia is set to become the second largest country by pension assets after the US within a decade. Our next guest runs the country's second largest superannuation fund, managing $236 billion for over 2 million members. Joining us from New York is Ian Patrick, who's a CIO at the Australian Retirement Trust. Ian, really great to have you with us, especially so late at night for you. First of all, tell us about the sort of ambitions for this visit, for this event, and how the reception has been.
The ambitions for the event, I think, are to drive home to the US administration the strength of the Australian superannuation system, the capital it represents, both in terms of $3 trillion in total, plus the $1 in $4 that are represented in US assets, so somewhere circa 600 million today, 600 billion today, going up over 10 years to 1.5 trillion. And that capital is patient, clean capital invested in a variety of US assets and supporting a variety of US infrastructure.
And this event comes at a time that is increasingly tricky for the investment landscape, right? Not least of which is the growing concerns over the private credit space. We're seeing now some of the go-to lenders restricting lending, investor exodus, borrowing defaults. Are you concerned about this? How much exposure do you have? And are you conducting more work in that space to look at that exposure?
In terms of alertness to the evolving situation in private credit, yes, clearly we keep that front of mind. The pain that we've seen, and I'm picking up the pain point on your underscore here, the pain that we've seen has largely been in funds that are not typically invested in by superannuation funds. Those are evergreen type vehicles that have some availability of liquidity on an ongoing basis, and there has been a demand for that liquidity. I think a credit cycle is inevitably going to lead at some point to defaults of some kind. We've been in a fairly benign credit cycle. Reassertion of that credit cycle is not out of the ordinary, but it is something we remain very attuned to.
Ian, I wonder how much of a concern the war scenario at this moment is. Are you adjusting the investment portfolio?
In terms of Australian Retirement Trust, we have a very clear philosophy to employ our dynamic asset allocation strategy, which is based on movements away from fair value in various prices, whether they be national equity markets or national bond markets. Volatility tends to generate a degree of added value when prices do move away from fair value and then revert. That's what our response to volatility is, and this particular context is one of that kind of geopolitical induced volatility. I think there are broader structural themes that may, in time, cause an adjustment to the portfolio, were inflation to surprise to the upside and expectations around inflation remain sticky, then we would possibly adjust our portfolio. And I think the evolving question around the impact of artificial intelligence potentially on labour markets is another one that may in time. But current volatility associated with the Middle East conflict not leading to significant adjustments to the portfolio.
Ian, this week, what have you been hearing from American investors on Australia as well? I mean, how are you positioning amid this competition for global capital?
The story in conversation with representatives of the current administration, founders in Silicon Valley, investment managers in New York, that conversation has really been about the medium to longer term, fundamentally. And to give you an example of a discussion this afternoon, changes in the real estate dynamics, the fact that the continual under construction of traditional real estate investments as money has flowed to that significant uplift in data center construction, that opens up opportunities in those traditional sectors that now might, due to a relative undersupply, generate some level of return. So that's the kind of conversation that's been happening. It's been about opportunities in the medium to longer term, whether that be, as I say, in real estate or in response to the significant evolution of the industrial complex associated both with onshoring and let's call it overall resilience of supply chains.
Ian, when it comes to the US part of your portfolios, are you trimming exposure at all, or conversely, do you see opportunities in the market ructions that we continue to see? And if so, where are those opportunities?
I understand the nature of your question. In our context, we say to members, we undertake to provide you a portfolio with a certain level of anticipated exposure to, let's call it equity risk. And it's for our members to decide what their risk appetite is, because they have a choice between a high exposure to equity risk or a low exposure to equity risk through the investment options we offer them. So we are fundamentally going to maintain the overall shape of our portfolio in terms of its overall level of exposure to risk. But within that, we may vary the risk exposures between the various asset classes or the various geographies and sectors through time. As a consequence, we are not fundamentally altering the risk posture of our portfolios. It is more with the active choices within the various asset classes or across geographies and sectors that will vary our exposure through this kind of cycle.
Ian, great to have you on the show today. Thank you so much for taking the time. Ian Patrick, CIO at the Australian Retirement Trust. Coming up, we'll explore Asia's rapidly growing ETF space in a new weekly segment, ETF IQ Asia. Catch our exclusive with the CEO of CSOP, Hong Kong's largest ETF issuer by assets under management. ETF IQ Asia airs Fridays on The China Show. And of course, back to our top story, that's been oil for much of the 2 weeks since the war began. Brent is still sitting above the $100 level. And this is despite signals from the US Treasury to let Russian oil, more of that indeed, into markets. Joining us now, our oil trading reporter, Rongwei Neo, is with us. So Rongwei, we've been seeing increasingly this jawboning. They're exploring various measures. Now we're hearing about Russian crude, a bit more of it potentially to come on the markets. The crux of the issue, though, that's not fixed. So how are traders positioning?
All right, so firstly, let's talk about this latest announcement from the US Treasury to allow practically anyone to purchase Russian oil that's available on water that has already been loaded. So of course, coming to the end of the week, I think we are starting to see a pattern here where the US's Trump's administration start to come up with some sort of cooling measures to bring down oil prices nearing the end of the week, as we have been seeing oil potentially spiking, potentially touching $100 again. That already has went above that level a few times this week. Prices have been highly volatile. But what this announcement really means is that a lot of these, what I see is those that were out of the Russian market, which is your Chinese state-owned companies, as well as potential buyers in Southeast Asia, which have been quite a squeeze for crude supply, could potentially tap on some of these. Of course, we are still just keeping tabs and trying to make sense of how much oil is actually available on water, but it's definitely a kind of like a short-term relief. But Avril, like you might rightfully mention, the longer-term issue is still there. The war is still present. Traffic through the Strait of Hormuz is pretty much still stuck, and that's why we haven't seen oil prices come off much more strongly today.
When it comes to prices that we're watching, do we just kind of throw out the textbook when it comes to front end? We're looking at futures as some indication more closely now?
So it depends on the kind of time spread you're looking at. So if you're looking at the closer term, like the first to third month and all that, I think we are still seeing quite a bit of tightness. When you talk about like time spreads and futures, essentially what you're talking about is how the market sees how long this war would happen. And as of now, people are expecting between 4 weeks, although we're already halfway through that mark, to maybe like 2 to 3 months. But if we look at the longer term fundamentals, like if you're looking at future prices a year ahead, the narrative is still that, if you recall, coming to the end of last year, we had a lot of reports and estimates from agencies like IEA saying how oil is meant for an oversupply, even though that sentiment has came off slightly, like gradually over the months. Agencies like IEA have pared back on their estimates on how much oversupply we'll actually see in the market, but the consensus there is still that there will be an oversupply of oil in the market in the longer term. So that has reflected in the prices as well, and those are the fundamentals that still remain.
Rongwei, thank you so much. Bloomberg oil trading reporter at Rongwei New for us. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at some of the tech names trading across Asia. It is firmly another down day there. We are seeing, in addition to the energy crunch, we're seeing these concerns about the helium crunch as well. Data center investment concerns also weighing here. We're seeing broad downside for some of these chip names. Also with tech, Adobe CEO is resigning from his position with no immediate successor. Shantanu Narayan had served in the role for nearly 2 decades, but the company has faced deep skepticism about its ability to thrive in the AI era. Let's bring our Asia tech correspondent, Avril. So, Belle, this came as they also reported earnings.
Yeah, that's right. And actually the earnings came in pretty much in line with consensus. So that was very much overshadowed by the news that the CEO is stepping down, as you said, after nearly 2 decades at the helm of this company. They are saying that he's stepping down with no immediate successor. So the search does now begin looking at internal, external candidates as well. But it's an interesting move because, of course, with all of this SaaSpocalypse fears this year and fears around how much AI would hit the software sector, Adobe has been a name that's been raised time and time again, and you've seen that in the share price, for instance, because you're tracking back down to around a 3-year low. So they're really seen as struggling to win customers in the face of many AI upstarts, essentially. Narayan is someone who actually oversaw a period of significant growth at the business. It was a time where annual revenue revenue actually climbed more than 6 times or multiplied more than 6 times. But as I said, those headwinds now that it's facing from AI have prompted this leadership change. And the company says it is focused on finding that successor. Interesting to note as well, just the reaction we got on social media, because you had the likes of Microsoft's Satya Nadella, for instance, just talking about the legacy that he builds or that he's leaving here, and really what he's built at Adobe as well during this time period. He is staying on, I should note, as chair of the board.
Belle, let's talk hardware, because now the chip sector seems to be, among investors, showing those concerns about helium supply disruptions. Talk to us through these issues that investors are worrying about.
Yeah, so this is actually becoming quite a significant risk for the industry. So it is important to get through the technical side of this. What you need to understand essentially is that helium is indispensable in the chip making process. It's not used as an ingredient in the chip itself, but it does have exceptional cooling capabilities. And so as chips become smaller, it becomes even more important to cool them quickly so that you can have better yield, more precision in the etching process. And so helium is not a product that can be replaced. It's indispensable, actually. And with the world's largest LNG facility coming offline in Qatar, that's Las Rafin, following an Iranian strike, you can see it's taking out nearly a third of global production. The connection here from LNG to helium is that helium is refined. It's a byproduct essentially of LNG, and so that's why this facility is so important. There's no viable substitute for it either in the chip making process, particularly important for advanced wafers, so you're talking 5 nanometer and below. What happens next? This is what's really not clear right now. We are hearing things like, for instance, if you do have that helium shortage, you're going to have the chip makers, the fabs that are going to be forced again to continue prioritizing more advanced technologies at the expense of more legacy ones. So you could see that memory chip crunch, for instance, being extended, even though we've already heard from the likes of SK Hynix, TSMC, for instance, that are saying they do have buffers in place for now. I think the big question, and that's what our team is flagging from our geoeconomics team, is that if it extends into the second half of the year, that's when you really see the troubles bearing out.
And those two companies, interestingly, are the biggest drags on the Kospi in the early goings. Belle, good stuff. Thank you so much. Annabelle Dwellers for us there. You can find the latest tech coverage on our dedicated Bloomberg Tech YouTube channel. We have more ahead on the Asia trade. This is Bloomberg.
Watching automakers today, Honda in particular in focus for all the wrong reasons. The Japanese car maker facing up to $15.7 billion in charges, an annual loss that is historic. It joins a list of brands battered by the EV transition. Bloomberg's Japan transportation reporter Nicholas Takahashi joins us now from Tokyo. So how did the sudden slowdown of global EV demand push Honda? We've seen years of profit. Now we could be looking at the first annual loss since 1977.
Yeah, so this is a painful, if not surprising, moment for Honda. We're not used to the car maker seeing such big annual losses like this. Like you said, it could be the first annual loss in nearly 50 years, if not more than that, dating back to when the company was listed in the 50s. In simple terms, Honda put too many eggs in one basket. As the industry shifts towards EVs with sophisticated technology like we're seeing in China, Honda put a lot of money behind its EV push. And in a lot of ways, the cart got before the horse, and now it's suffering.
So is it going to tweak its strategy a bit, focus more on hybrids rather than full EVs then going forward?
In short, yeah. So the company explained to us that it's gonna take those losses, the 2.5 trillion yen, which is pretty big, even when compared to American car makers like Stellantis and GM. But part of that strategy is to pivot and reallocate the resources it hasn't spent on its EV push and putting them back into internal combustion cars and hybrid cars, which it's kind of been lacking on in recent years. But that's going to be a fundamental struggle because part of the reason its car business has been declining in the US and in China is its lack of a competitive edge in both markets.
Bloomberg's Japan transportation reporter Nicholas Takahashi there in Tokyo. Some of the other stories that we're following in the auto space, and Stellantis is exploring deals with Chinese car makers to invest in its European operations, including acquiring stakes in Maserati or other brands. Bloomberg has learned that company executives have met with China's Xiaomi and Xpeng to discuss options. Sources say the talks also covered access to automaking capacity as Chinese firms seek to grow in Europe. BMW sees little room for improving profitability this year because of tariffs and intensifying competition in China. It expects an automaking margin of 4 to 6% after it declined to around 5% last year. The company said sales in China, still its largest single market, will remain broadly stable. CEO Oliver Zipse has managed to keep the luxury car maker steady despite supply chain shortages and an uneven shift to electric vehicles. Avril.
Heidi, here are some of the stocks to watch when markets open in Taipei. Really, the focus is going to be on Asia's biggest stock, right? Shares of TSMC and its peers will be in focus as the Iran war sparks supply concerns for helium. And of course, this, as we know, is essential for semiconductor manufacturing. TSMC's ADR slumped more than 5% in the New York session. So it's really not just about the energy shock, the higher oil prices, the concerns about inflation. It's also the access to some of these other commodities that are required and go into the chip making process. Take a look at how the Hang Seng Tech futures are also pointing a bit of a softness that's expected. This is, of course, following on from the drags that we're seeing in South Korean chip makers in the region already. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in the Greater China region. The China Show is next. This is Bloomberg.